Welcome back to OSC Dialogue. My name is Paul Redman. I'm the Director of Regulatory Strategy and Research at the OSC. It's my pleasure today to introduce our keynote speaker, Bank of Canada Deputy Governor Paul Beaudry. But before I do, the OSC and the Bank of Canada would first like to acknowledge that we are meeting on the lands of the First Nations, Inuit, and Métis. We pay our respects to the Indigenous peoples across this country and to their ancestors for their immeasurable contributions to this country. Paul Beaudry became Deputy Governor of the Bank of Canada in 2019. In his role, he oversees the bank's financial system activities and shares responsibilities for setting monetary policy. In 2021, or since 2021, he has also overseen the bank's analysis of international economic developments in support of monetary policy decisions and serves as the bank's G7 and G20 deputy. Before joining the bank, Mr. Beaudry spent 25 years as a professor at the University of British Columbia. He's also held academic positions at Oxford University, Boston University, and the University of Montreal. He was also a visiting professor at the Massachusetts Institute of Technology, Pantheon-Sorbonne University, and the University of Toulouse. Mr. Beaudry held the Canada Research Chair in Economics from 2000 to 2015 and is a two-time recipient of the Bank of Canada's Research Fellowship Award. Born in Montreal, Mr. Beaudry holds a BA in Economics from Laval University, an MA in Economics from the University of British Columbia, and a PhD in Economics from Princeton University. The OSC and the Bank of Canada have a deep shared interest in the stability of Canada's financial system, so it is my pleasure to now welcome Deputy Governor Beaudry to the OSC Dialogue.
Well, thank you very much for that introduction. And bonjour à tout le monde. Good afternoon to everyone. It's really my pleasure to be here today to be able to talk to you, and thank you for this invitation. We really have at the Bank of Canada a long-standing relationship with the Ontario Securities Commission, and we really appreciate the role that you play in favoring a stable and well-functioning financial system. Now, today I'm going to come and talk to you about financial vulnerabilities or financial issues that we see in the Canadian landscape. And this is part of our commitment to kind of report twice a year to Canadians about those type of issues. We do that in the spring through our financial system review, and we do it in the fall by a speech. Now, when we talk about financial vulnerabilities, these might be problems that don't kind of work themselves out. They're not necessarily issues that kind of create problems, but what we've learned through the years, if we don't keep an eye on them, they actually might interact with other things and start creating problems for the economy, or they might actually develop into kind of bigger long-term type of issues. And that's why we want to keep an eye on them. Now, before I talk about the vulnerabilities here, I want to kind of take a step back and think about the state of our financial system as we entered into this pandemic. In many ways, we entered this in a good health as a financial system, and that reflects the good regulatory and supervisory system that we have. Banks were well capitalized. As we went through the pandemic, there was a lot of support in terms of helping households and businesses get through. And when we look as we're kind of coming out of this pandemic, we can see some of the fruits of all those pieces as we have households insolvencies and corporate bankruptcies at very low levels. So that's kind of the good news. But that doesn't mean that there's not any vulnerabilities in the Canadian financial system. And that's what I'm going to want to talk to you about today. Now, there's certain vulnerabilities we've been following for quite a while, and this in particular in Canada is on the household side. And this includes housing market imbalances and high indebtedness, is particularly the aspect of some households that have a lot of debt relative to their income. Now, we want to also discuss issues related to climate-related risk. And if you think right now with the events that are happening in BC, that kind of reminds us of the type of difficulties that we might be facing ahead with climate-related kind of issues. So that's also an issue I'll want to be talking about. Now, before I get into any of the details, I do want to kind of mention right from the start, we think our financial system is currently in a good state. It would really take a really big shock to really kind of make big problems to our financial system. But nevertheless, we think these vulnerabilities we'll be discussing today could interact with different shocks in the system and create challenges for the economy to potentially exit this pandemic or actually have problems down the line. And that's why we're keeping an eye on them. Now, so let me start by getting into these household type of vulnerabilities. So these involve these two types of issues. There's really the housing market imbalance and the high indebtedness. And both these interact very much together and have interacted over this pandemic. Now, at the beginning, what we can kind of see is one of the big drivers here has been the increased demand for housing during this pandemic. And there's many reasons there was increased demand for housing. On the one hand, a lot of us kind of noticed that we kind of wanted more space as the pandemic arrived. And we kind of saw that, you know, the way that we're working in the future might be different and allowed people to like look further out and buy homes further out from center cities. We also had, a lot of people had extra savings because we couldn't actually go out and buy as many things as we can usually do. And that kind of contributed to the possibility of actually, for example, going and having a better down payment. And obviously the lower borrowing costs or mortgage rates during the period. That all contributed to having more housing demand. Now, that increased demand for housing actually led to increased housing prices. And what I want to be talking about is we see that a particular problem if it starts creating what we call extrapolative expectations. And I want to discuss that part in particular. Now, at the same time as that kind of dynamics in house prices, well, that was kind of related with people had to go out and kind of take mortgages, especially first-time buyers. And some of them had to take on large mortgages. And we want to understand how that developed through this whole system. So I'm going to start off by looking at the house price dynamics. Je voudrais juste noter pour notre auditoire francophone que tous les graphiques que je vais présenter ainsi que le discours de ce texte est disponible sur le site web de la banque. So when I'm looking here in terms of the housing market, we have two different lines here. So the blue line is just a sales to listing ratio, and we see there was a lot of activity as we get into this pandemic. What I want to kind of get your eye on is really the red line, which is house price growth on average in Canada. These are 3-month growth rates put at annual levels. And what kind of strikes your eye is that peak at kind of the end of 2020, beginning of 2021. That is really high price, house price growth. And you can see even relative to kind of the period where we had, you know, earlier in the kind of 2016-17 period, we had high price growth. Now it's actually been higher. Now, through the pandemic, and especially through the summer, we started seeing some cool down there, and that was a good sign. And, you know, part of that was kind of expected. We had the mortgage stress test that kind of encouraged people to kind of wait till they had bigger down payments to be able to get into the housing market or maybe buy smaller houses. But what's more problematic if we've been seeing a reversal more recently and we've seen the house price growth starting to increase again. So we have this aspect. Now, we're not too surprised that in the short run, when there's a lot of housing demand out there, that there's going to be an increase in house prices. What we'd want to think is how does that adjust in terms of different aspects as we look forward? Well, in particular, to get that idea is we need this kind of concept of how elastic is housing supply in Canada. And here we don't want to think there's only one housing market. There's many housing markets in Canada. And here we've been doing work at the bank to try to get this kind of idea of how in different cities does the supply of housing react to an increase in price. What you should notice from this figure, and these are kind of estimates for this kind of elasticity for different cities across Canada. And the ones on the left of your screen, if you read some of the names behind there, you'll see it's all our major metropolitan areas, which means that these are areas where even when there's a big demand, most of that kind of lines up in terms of increased prices instead of having increased quantities. Now, what can that do? That means when there's a lot of increase in demand in the system, prices start to increase. the type of dynamics that is dangerous at that point is when people just see the price increase and think, because prices have increased, they're going to keep on increasing, and so I should get into the market right away. This is the kind of fear of missing out type of aspect. And that's what we call extrapolative expectations. People are just using the past to kind of predict that kind of future, and that can create dynamics that is dangerous for the system as we get prices departing from their fundamental values. So what we've been doing at the Bank of Canada is trying to create an index of that kind of indicator of that extrapolative expectation. And here we see a heat map which kind of covers a set of cities for Canada. This is not about the level of prices. This is about the dynamics of prices. So we're trying to look at prices that look like they're kind of creating that extrapolative expectations. And what we can see is a lot of the areas which are in red now at the end in this kind of pandemic era is a lot of those cities that are major metropolitan cities, and a lot of them that have this limited supply response to price increases. And that's what we're kind of keeping an eye on. Now, we're not saying right now that there's a huge problem everywhere, but there's kind of places that we have to keep an eye on here. Now, also, when we look at this, we want to think about the different players in this housing market. And what we see through this figure is, there's been a lot of increase that in terms of purchases of new houses that came from new first-time buyers, okay, that's on the figure, and then repeat buyers, people that already had a house that decided to move, and that was a big increase also during this period. But the major increase, or the kind of one of the dominant ones that kind of grew especially fast, was the investor category, and we see that increased very rapidly through this period. And that investor category means there's an extra demand aspect there. And it's especially that part where people could be getting in, trying to kind of make those capital gains, and especially reacting to this extrapolative expectations. So this is an area we're kind of looking into and trying to figure out the role of investors play in this type of dynamics, and we'll want to kind of keep an eye on that as we go forward. So just summing up in terms of these housing market imbalances, okay, well, what we've all known is that house prices have increased significantly over this pandemic. Okay, we did see a little bit of moderation over the summer. We were kind of hoping that would continue. Right away, right now, it's kind of turning the other way, which means housing is very expensive. Okay, but that means that there could be corrections in certain markets, and that's what we're keeping an eye on. And those were that aspect, and that aspect of thinking where could there be these extrapolative expectations. Okay, now I'm going to move on and talk a little bit about this issue of indebtedness. So it's related to housing, but this is more general and trying to think about the aspects of how indebted people are in Canada. Now we can kind of wonder, why are we looking at that? Okay, directly, these are decisions people make. They decide how much they want a housing, how much they have to borrow for that. But what it's the question for the financial stability of the system, it reduces the flexibility if some people are very highly indebted. Okay, so we're particularly worried about very highly indebted households, because these are households that'll have much more difficulty reacting to shocks and reacting to kind of negative effects of their incomes or different changes in the environment. And that right now could be bigger because we're having more of those people, and more wealth is actually concentrated in that housing market. Now, interestingly, through the pandemic, indebtedness had kind of two conflicting kind of forces at play. On the one hand, there was kind of increased savings that allowed people to kind of reduce some of their debt, and then on the other hand, there was new people kind of coming in and increasing debt. So we'll want to talk about those two forces there. We'll also want to take a step back and look at this from a long-term perspective, because this isn't something new. This isn't something that's concentrated in this pandemic. It's been going on for quite a while, and we'll want to look at that from that longer-term perspective. So first, thinking on this kind of positive side in terms of the forces that kind of reduce or potentially reduce the indebtedness, is the aspect that through this pandemic, a lot of people have managed to save a bit more. Okay, now that's not always a good thing here. It's because we weren't able to kind of go out and do the things we liked. We couldn't go to movies, we couldn't go to restaurants, we couldn't travel, and this allowed people to kind of save more. And it's actually quite substantial. Per person, we kind of estimate that people managed to save about a bit more than $8,000 per person in Canada. So that's quite a bit. Now, some people have used that to actually pay down debt, and that's also the good news. And so if you look at the red line here, this is the kind of fraction of the population that's behind in some type of debt payment. That could be on mortgages, could be on credit cards, could be on other aspects. And what we see is that's at that very low. And that's what I kind of said starting in the beginning. That's the aspect that we're coming out of this pandemic with these low kind of problems in terms of people paying their debt. And that reflects also that people actually paid off some of their debt. And if you look at the blue line there, this is maybe one of the most extreme, but people were paying debt off, all sorts of debts. But this is the credit card balances, and we really see that the balances on credit card really reduced over this period, giving that room, extra room in terms of people's indebtedness. Now that's the good news. What was kind of the countervailing force and kind of was more of a difficulty was new borrowers. We had new borrowers coming in, so they're taking on new debt. Other people might be paying down. Some people are kind of taking on new debt. So the black line tells us the fraction of people taking new mortgages that actually are people that are taking high mortgages relative to their income. Okay, the black line is actually the one that's kind of overall for all mortgages, and the other two lines reflect the insured and the uninsured market. What I want you to note here is through the pandemic, this has been kind of increasing a lot. So we've had among the new borrowers a lot of people that have actually increased. We had more people that have kind of entered into this category of high indebtedness. So how does that balance out overall? Some people paying off, some people getting in with more. Are we in a better or worse situation? Well, one of the nice things is very recently StatsCan kind of came out with data that really gives us a good idea of the balance sheet of Canadians. Now that was data that's up to 2019, and we could actually look at that data and get an idea of the general balance sheet of Canadians. And prior to the pandemic, things started to look pretty well. A lot of people, on average, their net worth was increasing. And we actually saw a stabilization of this fraction of people that are in this high indebtedness category. And that's what we see here in kind of the 2016, 2019. Now, as we get into the pandemic, we don't have all that data from StatsCan, but our own kind of data can allow us to try to rebuild those balance sheets and look what kind of fraction of people now are in this high indebtedness category. And actually, for the first year as we got into the pandemic, actually our calculations is things have improved, okay? So this is a good sign. The fraction of people that are in this high indebtedness category actually decreased. It was a mix. Some people were paying down that debt, some people increased, and the paying down was kind of winning. But now as we get into the second year, it's kind of flipping around, and we're back to seeing this increased indebtedness in the among people, okay, this aspect of having a fraction of the population that's highly indebted, and that's what we kind of keep track of, and that's what we get worried about. Okay, now I want to step back. So that was looking very much in this pandemic kind of focus. Now I want to take a step back and look a bit more in the long run to understand this indebtedness and how it's affecting things and how we should think about it. So the red line in this figure is the 5-year mortgage rate. And what, the striking aspect, this is over 20 years, and it's been a steady decline for 20 years. Now, this is not a feature that's special to Canada. If we looked at, the US, most advanced economies, many emerging economies, we see the same thing. This is a global trend in the world. We think about this as driven mainly by structural factors like the aging of the population, the high savings rates in certain emerging markets, lower productivity growth. All these factors are playing in to kind of reduce this longer term rate on the interest rate. Now, the Bank of Canada affects interest rate, but it doesn't control long-term trends like this. These are kind of determined at a world type of level. Now, as interest rates have declined like that, what we've seen is people have gone out and borrowed, and the green line is actually that aspect of how much debt has increased in Canada through this period. And now we see two offsetting effects here again. On one hand, people are taking on more and more debt. At the other hand, the interest they pay on it. So one thing we can ask is, how has the amount that people actually pay relative to their income on their borrowed amount has changed? That's the debt service ratio. And interestingly, that has actually stayed about constant in Canada. So there's been this countervailing. As interest rates increased, people have taken debt, and the kind of overall payments that people make on their debt is about constant. Now, that's the average in Canada. That kind of captures just only the average. There's a lot of variation. Some people have kind of had, a lot of increase in those payments. Some people have decreased, but it just gives you an idea of what happens as those two trends. Now we can kind of wonder, how does that affected household ownership? So here we have data on ownership of housing in Canada. We have it by different age groups and looking again over this 20-year period. And so we have it for different years over the last 20 years. Now, there's different slight variations in these groups and everything, but I think the most notable aspect of this is to see that in general, these ownership rates over 20 years haven't changed very much. So with all these forces at play, this has made that, people have found a way to kind of keep on owning houses in Canada. Does that mean that it's as easy as it was before? Well, it's really the aspect that what we see here is for people to now do it, now have to take on a lot more higher debt relative to their income, and that's the type of vulnerability that kind of we worry about. Now, that's vulnerability because, if you have a high debt to income and you have, a shock to your income or interest rates increase, you might have difficulty servicing that type of debt. Now we have, the mortgage stress test has kind of been adjusted to try to kind of protect the financial system of kind of saying how, not to lend to people that couldn't pay if interest rates increased partly. And so the system has kind of taken that in part, but it still means that the people that are in those high indebted situations, if their conditions were going to change, they could be in difficulty. And that means the economy could, because that group is big enough, could be in difficulties of adjusting to different types of shocks. And that's the type of vulnerability we keep an eye on. So just summing up in terms of these vulnerabilities associated with indebtedness, well, so again here, through this period, we've kind of had that, through the pandemic, we actually had a period where things improved a bit, but now it seems to be increasing again. What worries about us is having that kind of set of people that are highly indebted is they're not very flexible if things happen to their income or interest rates change. It might affect how they'll have to kind of adjust. And that means the economy could react badly to shocks, even though we think that the financial system is well protected given the system, the way things have been structured, in particular the mortgage stress test. Okay, now I want to move away from this kind of household focus and move into kind of discussing a bit risk related to climate, okay? And again, as I said before, we have, issues that kind of remind us of what climate can do to our economy. We're seeing that right now in BC with all the difficulties that are going on there. So when we think about the risk associated with climate, there really is two types of risk, and we want to differentiate these different risks. Okay, on the one hand, we have physical risk, and that's exactly the type of risk associated with storms, floods, fires, different things that are directly related to the climate. Then there's a different type of risk, which is the transition risk. As we try to move to a lower carbon economy, we're going to have adjustments that need to be taken into the economy, and that also creates risk as we have to move people from different sectors. Sectors need to adjust. Now, what can we do in terms of the financial system to try to help that kind of transition and kind of help things? Well, we have to make sure that asset prices are well priced in the market. Want them to be kind of reflecting the real risk in the background. And it's by having those assets that are well priced that we'll get the investments we need in the right sectors to help us kind of transit in this type of environment. And if we don't have the right prices, we could see people kind of getting really unexpected kind of losses in their investments and having potentially stranded assets. Now, we know that to kind of price things right, what is particularly important is information. We have to have information about how these things like climate change is affecting us. And this is where we've been working at the bank in terms of developing tools that are going to help us try to evaluate the risk associated with climate change, and in particular developing what we call scenario analysis. We've been a leader and kind of participating with other central banks around the world to kind of develop these tools to look at how climate change might affect us. To give us a bit of an idea here, I'll give you a few scenarios and how these can be used. I'm going to stay at a very high level. We will be giving a report more detailed about some of these scenarios and how it's affecting the Canadian economy in January, and a lot of this work is actually joint with OSFI. Now, here's a first scenario. Is kind of like if the world keeps on doing what it's doing right now, we can see the red line is basically looking at the greenhouse gas emissions that would be put out in the atmosphere every year if we keep on doing what we're doing now. The policies we have in place in Canada and around the world, if those continued, all it would do is kind of balance out and we'd stay at the same amount of greenhouse gas emissions. That means we'd have a lot of risk, physical risk. So if you look at the right-hand side here, on the vertical axis is kind of the idea of the amount of physical risk there is in the system. On the horizontal axis is the transition risk. So if we kept only on doing what we're doing now, we're going to have a lot of physical risk. We're going to have a lot of problems that are kind of like the ones we're seeing currently in BC. Now, at the same time, we wouldn't have too much transition risk because we wouldn't be doing too much of a transition. Now, on the flip side, we can think about paths that are actually consistent with our goals of the Paris Agreement. That is, trying to get these greenhouse gases to zero or close to zero such that we can keep the temperatures at preferably 1.5 or at least below 2%. And these are the two scenarios, a 2% scenario and a 1.5 scenario. If we followed those scenarios and started implementing things right away, we can see that would really reduce the physical risk and kind of improve our aspect, but would cost a bit in terms of transition risk as we'd actually be trying to change the economy and get it to adjust to that new reality. So that's a bit where we see things as we're moving there. Now, one of the things we learned here is looking at an alternative scenario would be one where the world does not start doing things very different right now, but waits until 2030 to do things and then does things more drastically. And that's the yellow line. So that would be a different scenario, and we can ask how do the economy and the world adjust to that. And what we see is relative to acting right now, the yellow dot is one where we're seeing we'll have, if we do that, we'll have more physical risk because we're kind of longer in this environment with more greenhouse gases. And we'd have also more transitional risk because we're trying to do things very rapidly, and that's hard for the economy to do. And so we can really see that at a high level, what we learn by this scenario is really the gains from moving immediately and trying to adjust as opposed to waiting and adjusting more drastically later on. Now, all that I've said here is very much in line with the type of declaration that the Bank of Canada made at COP26, reflecting our interest in favoring a safe financial system that is capable to cope with these type of issues related to climate risk. Okay, with all that said, it's a bit time now. I've thrown you lots of data, different parts, and I just want to wrap up here. Well, the key message I want to take away is the vulnerabilities that we've been following for a long time at the bank, in particular at the housing sector, in terms of house prices and indebtedness, are still with us. And in particular, that gap between supply and demand in the housing market has actually increased during the pandemic, and we actually have those higher prices of housing now, and that's an increase in that vulnerability. On the side of the indebtedness or this high indebtedness households, that actually at least had a bit of improvement at the beginning of the pandemic and now has started to kind of move back and getting worse. So we're kind of worried about that. Now, when we look at all this, we think our banking system is in a good position to be able to manage these type of risks. But nevertheless, these vulnerabilities can interact with different shocks, with different things that can happen to the economy, making it that it can challenge the economy as we try to get out of this pandemic, or could create those problems further down the line. That's why we'll keep an eye on the financial situation of both households, businesses, financial institutions as we move forward. We'll also kind of keep this kind of system-wide type of perspective, and in particular trying to take on these aspects of looking at climate-related risk. Pour mon auditoire francophone, je voudrais aussi juste finir par dire les messages clés qu'il y avait dans cette présentation. Donc, on a vu de la Banque du Canada, ça fait plusieurs années qu'elle suit certaines vulnérabilités, et ces vulnérabilités sont encore avec nous. Sur le côté de l'habitation, le prix des maisons, on a vu qu'on a une augmentation qui a continué sur ce côté-là, donc cette vulnérabilité-là, elle a augmenté. Sur le côté de l'endettement des ménages, on a eu une période où les choses s'étaient améliorées un peu au début de la pandémie, mais maintenant, ça commence à se empirer encore. Donc, le groupe de ménages fortement endettés est en train de grossir à nouveau. Si on regarde, on pense que notre système financier et nos banques sont dans une bonne position pour gérer ce type de risque, mais il reste tout de même que ce genre de vulnérabilité-là crée des défis pour l'économie, comment elle va s'ajuster à mesure qu'on avance. Donc, c'est pour ça qu'on va garder un œil sur la santé financière de nos ménages, de nos entreprises et de nos institutions financières à mesure qu'on avance. Et on va aussi regarder de façon plus large les éléments reliés à des questions comme le changement climatique. And with that, I thank you very much, and I'll be open for questions.
Thank you, Deputy Governor Beaudry, for those insightful remarks. So we have some time for a Q&A from our audience, but first of all, I'm going to take advantage of moderator's privilege and ask the first question. So one of the topics you've touched on, and one of the topics we had discussed in a panel earlier today was the environment and climate change. I think it's well recognized that there's a growing need for the official sector to support the transition to a more sustainable future. How does the Bank of Canada see its role in promoting considerations of climate risk and the transition to a more sustainable economy?
Thank you very much for that question. It's a very relevant question. And here, when we want to kind of think about it, everyone has to play their role when we're thinking about climate change and how we're going to adjust. And in terms of the Bank of Canada, we see our role as kind of favoring a stable and well-functioning financial system. And that's really the aspect that we kind of see a large part of how we can help. We're trying to get, as I kind of mentioned in the speech, trying to help getting the information that's needed for the financial system to be able to kind of evaluate risk and kind of disclose risk. And we're trying to help by leading by example of how ourselves are going to try to disclose the risk that we see on our balance sheet and our situation. So that's the parts that we see it very much through our financial stability mandate.
Thank you for that. Another question, for maybe changing track a little bit here, turning our minds back to last year and the onset of the pandemic and its impact on financial markets. What do you think are some of the key takeaways, the lessons learned from the experiences of the spring of 2020? And what did we learn about promoting the resilience of the financial system?
Well, like you say, the spring last year, in particular in the financial markets, was really a period of real turbulence. Okay, the type of shock that we had here was really special, and it kind of took people by surprise, and markets had real difficulties adjusting to it. And the Bank of Canada tried to help. In particular, there was a lot of liquidity problems in the system, and the Bank of Canada came in, tried to put in liquidity facilities and help the system. And what we learned is that, it's not surprising that in such a big shock that maybe the Bank of Canada has to come in. But since then, we've been kind of looking at whether there's well-managed liquidity provisions in the different financial institutions. And we've been discussing with a lot of those partners of ways that they could try to improve their own liquidity management, trying to look at that. That's also a thing that's being done at the more global level of looking at that kind of the different institutions of whether they're managing the liquidity, such that if we face a shock like that or something close to it in the future, we might not have to intervene as much. We'd really want to have the system being able to control and kind of manage its liquidity better. But again, when things are really difficult and very surprised like that, the Bank of Canada is there and tries to help and kind of come in and help with liquidity.
Great, thanks. Turning back to one of the vulnerabilities you discussed already, which was housing prices and its impact in Canada. I mean, this is something, it's almost become a bit of a Canadian sport, right, to talk about housing prices and whether they're going up and how fast they're going up. The Bank of Canada has noted this as a vulnerability for some time now. How do you see the bank's role in addressing these sort of maybe speculative pressures or this, the upward pressure in prices? Is this something that the bank has a perspective on, and what can be done to try to limit those price increases?
Well, again, here, we're trying to develop some tools to try to get at the ideas. Now, when we have demand coming in, so if we look at overall, like I kind of suggested, these long-term trends of declines in interest rates across the world and different things, we're not surprised that that's going to kind of lead to people to kind of be able to borrow more and buy houses, and that's going to push up prices in housing. So there's part of that aspect that's kind of a natural kind of implication of that kind of fall and that trend interest rates over a long time. What we're more worried about is when that kind of starts creating this type of panic buying or this kind of extrapolative expectations I was talking about, that type of dynamics that isn't healthy, which is kind of getting things further and further from those fundamentals, which can then create corrections. So part of us, and this is part of the work that we've been doing, is trying to figure ways of getting some indices that would tell us where we might see those problems. And again, trying to inform people so that they can look and try to figure out whether this is a good time to buy or not in their market. And so by informing people, that's a role that we can try to help and get those pressures. So a lot of the aspects that we move in that direction is a lot on that information side too.
Great. Thank you for that. Turning back to the scenario analysis that you mentioned in your presentation, and the forthcoming work between the Bank of Canada and OSFI, I think, are those scenarios potentially of use for a broad set of Canadian industries and issuers in this country, or is that something that will be helpful for all of them in sort of identifying potential scenarios and the impacts there?
Yes. So the idea is to make all these scenarios, and there's a lot more granular information than the kind of what I showed you here. I didn't get into all the details. These scenarios get aspects of thinking about, what sectors, how they'll have to adjust, what might be the technology choices that'll happen, a lot of information. And exactly, we want to make those scenarios available to people. And actually right now in the kind of pilot project that we've been doing with OSFI is exactly looking at a set of partners. At this point, it was ones both in banks and in pension funds and insurance companies, all those type of environments, trying to help them use some of this scenario to evaluate for them what is the risk associated with climate change. Now, eventually, these scenarios could be kind of used more broadly for others. It's exactly that type of tool that can help evaluate risk. Especially, we have to always think risk in a case like climate change is not something that we can go back and look at what it did in a previous time. We haven't had anything like this this period, and especially as we try to transit away from the use of carbons, it's something that the economy's been relying on for 200 years, and to kind of change that is a big change, and these are tools which I think can be useful to kind of evaluate for many players in their system.
Great, thank you. Maybe changing to a slightly different topic. One of the questions we have is, and this is, I know, something well in your wheelhouse, although maybe something that we could take the rest of the afternoon to discuss, is what is quantitative easing? And does that have an inflationary impact?
Okay. So you have to break down two parts in that question, okay? So quantitative easing is the aspect of us at the Bank of Canada of going out and buying certain types of bonds. And, you usually have our policy is really to affect interest rates. When we try to kind of conduct monetary policy in Canada, we look and try to figure out what is the right interest rate that Canada needs right now to try to get its economy to use a full capacity such that we can attain our 2% inflation target. Now, in times when we kind of hit what we call the effective lower bound, when the interest rate is basically set at zero, our short-term policy rate can't be used. But we still have tools to try to go out further and affect interest rates further out in terms of the yield curve. And so what we're doing by quantitative easing is going and buying some of those bonds at that higher end. So trying to put up, buy those bonds and increase their prices, thereby reducing that return and recreating the stimulus. Now, in general, you should think about those type of tools of either a short rate or quantitative easing as tools that both affect the economy in rather similar ways. There's not like one that affects more inflation than the other. Both of these are kind of to help us manage the demand needed in the economy to get to full capacity use. And those two tools, now if we overstimulate and move above that capacity, then that can create inflation, and that's the aspect that we have to kind of keep an eye on.
We have a couple of questions here around crypto assets, cryptocurrencies, both from the perspective of are they a risk? Are they something that we should be keeping an eye on from a vulnerability perspective? And also, what sort of relevance do they have for the bank in terms of its role, in payments and currencies and monetary policy?
Okay, again, let's divide these two. So first of all, this is something we're keeping an eye on, and we kind of said it in our financial system review in the spring. It is one of the issues that we kind of keep in looking at what's happening. Up to now, we think it's not kind of developing in a way that's creating a systemic type of risk for our financial system, because there's kind of quite removed directly from our financial system. But as it grows bigger and bigger, it becomes more of a risk of thinking that we have more people invested in it, more aspects, more retail kind of investors in it, and that could kind of mean the same type of vulnerability I was talking to before. If there was a big adjustment in that market, as we're getting more and more people involved, this could have an aspect. So we're not at the point yet of kind of thinking this is creating a big risk for the economy, but it is something we're keeping an eye on very closely. Now, in terms of how it's affecting payments and things, most of the kind of crypto right now, although it's been sold as the idea that it play a big role in payments, it really doesn't play that much of a role in payments. Most of it has kind of been concentrated on a much more speculative part, where people have been buying this mainly to speculate. We don't see it used that much in the payment system at this point. But looking forward, more things like stable coins, which are not like Bitcoins, are kind of backed by actual assets, they would have the potential to play more of a bigger role in payments. And that's something we're also keeping an eye on. So kind of thinking about how the payment ecosystem is evolving, what are the different parts that are playing. And I do think it's really important when we talk in terms of this, this market, really differentiating between those kind of crypto assets like Bitcoin, which are not backed by anything. They're kind of in by themselves as just a pure payment, versus the stable coin, which is actually backed by things, and understanding the different role that those two types of crypto kind of products can evolve.
Great, thank you for that explanation of that. Just looking at some of the questions that are coming through here, I mean, one of the questions is around inflation concerns and what that means in terms of expectations for interest rates, and what that impact might have on the financial industry, other sectors, other industries. Obviously, they've become a little more concerned about borrowing costs and things like that. And I'm just wondering if you had a perspective on that. Is there a way that the Bank of Canada can kind of try to mitigate those concerns that people have about inflation and potential future interest rate increases?
Well, certainly that's kind of our core mandate is inflation, and so we have that. Our goal is to keep inflation near that 2% target, and right now we're not at that target. So we're kind of very much involved in trying to understand the forces at play and trying to communicate. So a big part is trying to communicate to Canadians and to the financial market what we're doing and how we're interpreting what's happening. Now, in general, we kind of think about setting interest rates to kind of control demand in the economy, kind of not having it run too hot or too cold in terms of demand. Right now, we're having a different type of shock. In large part, in terms of the world, it might be the overall demand for the world is creating these kind of bottlenecks and kind of high demand for kind of things like oil, different parts. From the point of view of Canada, that becomes like a supply shock. So we have certain things that are really increasing in prices, like oil and kind of cars and different things, as we have these shortages of parts like the semiconductors. And what we're seeing is we're trying to balance that out with a period where we're trying to kind of come out of this pandemic and let the pandemic kind of get, kind of leave that pandemic and get to a full kind of full capacity out of that. So we're kind of playing across these different forces. And we think that in our calculations, a lot of these forces that are international are more from this temporary part that's reflecting this kind of quick return of the global economy back to normal. And that over time, and we're giving kind of clear kind of indication of when we think. So over the next few months, we'll still be at this higher inflation rate. By next summer, we think a lot of those forces will start kind of moving away, and that will kind of bring us back down, should bring us back down to inflation closer to 2% by the end of next year. At the same time, we think our general policy of kind of keeping interest rates low during this period is actually helping us kind of come back and get out of this, the recession that was induced by the pandemic. And we think that the capacity should be fully absorbed sometime by the middle quarters of next year, which is when we're indicating at this point where we think we potentially would be raising rates, as we would want to control demand so that it doesn't contribute to that overall aspect that's kind of coming out from supply at this point.
Great, very helpful. Thank you. Turning back to one of the topics you mentioned in your presentation, which was around investor interest in housing markets and people buying second homes, maybe not to live in, but to as an investment property. What do we know about whether that investment activity is domestic investors, Canadians, who are in a position where they can get a second or third home for that purposes versus foreign speculators in our market?
For the kind of numbers I was showing here, where a lot of within the numbers we're kind of following right now, these are a lot of aspects among Canadians. So these are Canadians buying these investing properties. And so this is a big part is among Canadians buying properties as investments and potentially putting them on the market to rent or just holding them.
Last question. And maybe turning back to the topic of environmental issues, just sort of maybe your quick perspective on carbon markets and what role they have to play in helping that sort of transition to a more sustainable economy and market.
Well, again, the big thing, one of the big parts of helping this type of transition is getting the price of things right. Okay, I talked about different parts of getting asset price rights. But in particular, what we need to get right is the price of things that kind of are carbon intensive. And carbon markets are part of that, of kind of reflecting that price and allowing people to kind of trade on those type of markets to try to get the best allocation of where the kind of use and kind of the emissions of carbon should be. So that's in general a good thing, that it kind of increases the adjustment. People know what's the right price of things, and so then to take decisions accordingly. And that's really important for the transitions we'll need, because we need people investing in the right sectors and the right things to kind of help as we move forward.
Great. Thank you. So that's all the time we have for questions right now. So all that's left for me to do is to thank you, Deputy Governor Beaudry, for attending Dialogue today and for your very thoughtful and insightful remarks. I know the bank's assessment of financial stability and vulnerabilities is always something that's very closely watched in the markets. And I'm sure the audience has really appreciated your insightful comments today. So thank you very much.
Thank you. It was my pleasure.
And thank you for those who joined for this session. Our next session, Modernizing Canada's SRO Framework, begins at 2 p.m. See you then.